Guarantee of profits to a partner. Now students, many a times a partner is admitted into a business and he is given a guarantee that his share of profits for a particular accounting periods would not be less than the specified amount. Now this guarantee can be given by all of the remaining partners, by one of the partners, or a selected group of partners out of all the partners. Now students, why this guarantee should be given? I mean, it is the requirement of the firm. Sometimes you would actually like a person to become your partner. So in that case, you would have to offer him certain incentive, and guarantee is one of those incentives. Now, whenever this guarantee is given to the partners, this is actually brought into effect only when the actual share of profits accruing to that particular partner during a particular period is less than the guaranteed amount. That is, let's say we have admitted C into partnership, giving him a guarantee that he will be getting a minimum profits of 5 lakh during the year. And when we divide actual profits, his share of profits comes to rupees 4 lakh. That means there is a shortfall of 1 lakh. We guaranteed him 5 lakh, but he is getting just 4 lakh. So 1 lakh would have to be borne by the partners who have given him the guarantee. In case his share of profits exceeds rupees 5 lakh, so there would be no effect of guarantee because he is already getting the amount more than what has been guaranteed to him. Let us take a question to understand this better. A, B, C are partners in the ratio of 3:2:1. C has been guaranteed a minimum profits of rupees 20,000 by the firm. Now students, by the firm means by all other remaining partners together. The net profit during the year was 90,000. Prepare P&L appropriation account. So now students, you will have to be very careful in this, that first of all we will have to check whether there is an effect of guarantee or not. So let us start with it. The net profit for the year was 90,000. So by net profit, or we'll write it as by P&L by profit and loss account. In bracket we should mention it as net profit, which is 90,000. There is no other appropriation in this question relating to interest, salary or commission, etc. So directly this would be divided among the partners as profit. Partners capital account, profit, A, B and C. Remember, the ratio for distribution is given in the question as 3:2:1. So 90,000 divided in the ratio of 3:2:1 would be 45,000 for A, 30,000 for B, and for C it would be 15,000. Now student, here lies the problem. C was guaranteed a minimum profits of 20,000, whereas he is actually getting a sum of only rupees 15,000. That means there is a deficiency to C on account of this guarantee for a sum of rupees 5,000. He was guaranteed 20,000, he is getting 15,000. That means there is a deficiency of 5,000 rupees. This 5,000 would be borne by the remaining partners, that is A and B, in their profit sharing ratio, which is 3:2. That means this 5,000 would be provided to C by A and B in the ratio of 3:2, which comes to 3,000 and 2,000. So less guarantee to C, 3,000 rupees. So ultimate amount that would be payable to A would be 42,000 on account of profits, less to C on account of guarantee 22,000, that would make it as 28,000 of profits payable to B, and C will get from A and from B 3,000 and 2,000. That will make his share equal to 20,000, and the account totals out at 90,000. So now students, you can see that once we have made this adjustment, the share of C becomes 20,000, that is the minimum guaranteed amount, and this amount, whatever was the deficiency, was taken out of the accounts of remaining partners, that is A and B, in the ratio of 3:2. You must understand a point very clearly here, that in this case the guarantee was given by the firm. Let's say this guarantee was given by A only. So in that case, B will not share any deficiency. Any amount of deficiency would then have to be borne by A personally. We'll discuss that in the next example. Coming to this question of guarantee, ABC are partners in the ratio of 3:2:1. C has been guaranteed a minimum profit of rupees 20,000 by A in person. In person means only A has given the guarantee that C will get 20,000. That means students, in case there is any deficiency to C, only A will have to bear that deficiency. The net profit during the year was 90,000. Prepare P&L appropriation account. So coming to this P&L appropriation account, the first entry would be by P&L account net profit 90,000. This 90,000 would be divided among A, B and C in the ratio of 3:2:1. That is 45,000 to A, 30,000 to B and 15,000 to C. Again, we can clearly see that C was guaranteed a minimum sum of 20,000, but he is actually receiving 15,000. That means there is a deficiency of rupees 5,000. Now the question makes it very clear that A has given this guarantee. So this guarantee or this deficiency would have to be borne by A personally. So we will deduct it out of A, less to C, 5,000. A will get total amount of 40,000 as profits. There will be no deduction in B because he has not given any guarantee. So that would be 30,000. And C, we will add from A 5,000. This will make his total equal to 20,000, which is the guaranteed amount. So 5,000 deducted out of A and added to C on account of guarantee. Let us total out this account. It comes to rupees 90,000. So now students, it can be seen that in case it has been guaranteed by a firm, then the old partners will bear that in their profit sharing ratio, or in some cases the ratio for guarantee might be different. It would be mentioned in the question. And in case a personal guarantee has been given by any partner, that he is the only one who will bear deficiency in case it arises.